Hi guys, welcome to another video. In this video, we are going to learn about the things that need to be watched before investing. When it comes to investing, people have various doubts and various questions regarding this. I don't know how to invest, I don't know where to start, I don't know what to do and so on. So definitely this video will answer everyone's questions and clear everyone's doubts. So without any further delay, let's get started. The very first step in investing is plan your investment budget. Irrespective of your profession and irrespective of your income, you must save at least 20% of your income for investing purposes. For example, if your income is 50,000 rupees, you have to use 20% in that amount for investing purpose. That is 10,000 rupees has to allocated for your savings and investment. If not, then at least bare minimum of 10% should be invested in your future plans and goals. An ideal investor should spend 15 to 20% of his or her regular income into investing. If you are saying no, I don't have that much amount, I don't have that much money to save, means definitely you should work on that. You are spending more amount than you are supposed to spend. Either earn more or spend less. This is the only way you can start investing. People will not realize the importance of saving now itself, but eventually they will realize the worth of investing when it benefits them in future. So moving on to the second point, the second important step is set your investment goal. Why this is important? Because the goal decides the time period of your investment. Yeah, goals can be different for different people. For someone, their goal is to buy some super car or super bike. For some, it can be building your own house. And for some, even it can be travel the world. So goals can differ for different people. So you have to set your goal. So only this goal can determine how long you need to invest. For example, if your plan is to build a house, at least you need to invest for around 10 years of time. If you don't even have a goal, then it's also okay. Just saving the money is also a goal. So always have a long-term goals and start planning your investments according to them. So moving on to the next important step is this diversification concept. If you people doesn't know what actually this diversification concept means, kindly watch carefully. So there is a famous saying you might have heard before, don't put all eggs in one basket, which means you should not invest all your money in a single company. You should diversify your portfolio. For example, if your investment amount is 20,000, you have to diversify that 20,000 amount into various sectors and various companies. For example, some part in energy sector and some in IT sector and some in auto sector, some in banking sector and some in pharma sector. So this is just an example and not a recommendation. There are many other sectors also which you can't invest because the sectors or the companies performing well will compensate the company that is underperforming or performing bad. So this is why you should not put all your money in a single company. Moving on to the next, different ways to invest. Investing in stocks is not the only option in share market. There are many other ways you can invest your money in. There are stocks is one of the ways. And if you don't have time to watch the market and analyze the reports, then you can consider mutual funds and ETFs. ETFs are called as exchange traded funds. These are the replica of direct Nifty. If Nifty performs well, then ETF performs well. So stocks is not alone in the market. There are mutual funds and ETFs and index funds, etc. And if you are planning to invest in a particular stock, then there are some criteria and some parameters that you need to consider. For a beginners, it is always the safer side to choose the stocks between large cap companies and mid cap companies and to avoid small cap companies. Large cap companies are the companies with a large market capitalization and the companies with a small market capitalization falls under small cap companies. The reason why I am saying this is large cap and mid cap companies are already established companies and small cap companies has to cross many hurdles and difficulties to get succeed. And the very important thing is that please stay away from these penny stocks. So what is this penny stock? Penny stocks are like cheaper stocks whose price is rupees 1, rupee 2, 3 rupee, 4 rupee. Stocks with the price rupees less than 50 are considered as penny stocks. Only 1 out of 100 penny stocks has the potential to grow. As we discussed in the previous video, for investing you need to know the fundamental analysis, which includes annual reports. So you can find annual reports of every company in these sites, nsindia.com or moneycontrol.com, and there are many other sites. You can find every information about a company on its annual reports. You have to read at least annual reports of past 5 years so that you can compare one report with another report, like the sales or the net income or the profit or the loss, the assets, liabilities. Everything is listed in that annual report. And learn. There is no shortcut to get succeed in this share market other than learning. Don't look for cheaper stocks or don't look for penny stocks. Don't look for quicker profits. Find the fundamentally strong company, put your money, hold it for some time and let it grow. So after finding a fundamentally strong company, what you need to do? You have to buy that company, right? There's no way like you can directly purchase company stocks from the company headquarters. There are some stock brokers. Through them only we can able to buy the shares. There are many stock brokers in India like Zerodha, Angel Broking, Upstocks, 5 Paisa, etc. And the brokerages charges or differ from broker to broker. You may check with the individual broker and you can open a demat account from any of the brokers. So after opening a demat account from any of the brokers, you just have to buy and that's it. And this is the place where I find many investors are doing some mistakes. You should not sell the stock unnecessarily. You should not sell the shares until and unless when you have two situations. One is emergency and another one is company's bad performance. Do not mix up this emergency situation with your unnecessary expense. Going for a trip, going for a vacation, going for a movie, going for a party, buying an expensive phone does not come under emergency situation. If there is something very much urgent and critical, only in that case you have to sell the share and take the profit. And the second possible reason that you can sell is that if the company is performing bad for the continuous period of time or some major decisions taken within the company's board that affects the company's results, minor results are not at all an issue. I'm saying this for the continuous 4 quarters or 1 year, the company is not meeting its estimated value of results and keep on posting bad performance. This is the case, it means the company is performing bad. So at that time, you can remove that company. But remember, you have to remove that company and replace with some other companies in that same sector or in some different sector. But the thing is, you have to replace some other company. Now you might have understood when exactly you have to sell your shares. And moving on to the next thing, keep investing. No matter what, keep investing. You got promotion, keep investing. Got a hike, keep investing. Got a bonus, keep investing. The thing is, keep investing. Make it a habit of investing so that it will give some financial discipline. For example, consider a situation where you invest rupees 10,000 a month. For a year, it will be like 1,20,000 and you are investing for 5 years, then it will be 6 lakh. Imagine the returns after 5 years for this 6 lakh. It's a huge amount. Definitely it is a huge. So on my personal note, personal wealth comes with financial discipline. So we came to the conclusion. Let's get a quick summary of what we have seen so far. First thing is you have to plan your budget. After planning your budget, you have to fix a goal. After your goal is fixed, you have to know the concept of diversification. You have to know what are the different ways you can invest and how to select a stock, how to not select a stock. We have discussed. Once you decided a stock, then you have to open a demat account and start buying. Once you bought the share, you just have to hold on and have patience. Now you clearly know when exactly to sell the stock. Until then, just hold on and let it grow. And finally, keep investing. Whenever possible, how much ever possible, just don't stop investing. And that's it for today's video. I hope you might have understood what are the things that you need to know before getting into this investment journey. Kindly consider all these steps and start your investing journey as soon as possible. If you found this video very helpful, kindly share this video to your friends and family members. Make sure to like, subscribe to our channel. Meet you in another new video. Until then, take care, have a great day.